Hello and welcome to Inside Out, a show where we focus on individual stocks with in-depth analysis, deep dive into financials, and tell you about the key risk as well as triggers going forward. Hey, Sonal.
Hey, Nigel. A brand new show. And of course, as always, we'll not only talk about the key metrics that you mentioned, we'll ask the management all the questions that are in your mind. So let's not waste any time and get to the first stock. What do we have on deep dive today, Nigel?
Well, Sonal, the company that we're talking about is APL Apollo Tubes. Remember, it's the structural steel-based manufacturer here in India. Well, in terms of manufacturing units, it has close to around 10 facilities, which are located all across the country. The company's multi-product offerings include 1,500 varieties for multiple building material structural steel applications. It serves as a one-stop shop for a wide range of products, catering to a whole host of industries here in India. But it also has a vast distribution network of close to around 800 distributors that are spread across the country, and they have presence in 300 towns as well as cities. The company basically looks at avenues in which structural steel can be used and replace the existing material that's being used. The company's target segment includes pre-engineered buildings, door frames, home decor, and the company is well placed because indications are that India has a huge structural steel tubes based constructional potential. And as of the latest data, well, structural steel tubes as a percentage of the steel market here in India is at around 4%. That's much lower than global peers. Expectations are that this percentage will move up big time by 2030. And if that happens, then structural steel tubes as a percentage of the steel market moves from around 4% all the way to double digits potentially.
Interesting data out there, Nigel. I got that. But APL Apollo, as you said, is a pure play on structural steel tubes in India. But tell me more about company's capacity and what are the expansion plans from here on if they are planning capacity expansion?
Let's address that then. Well, APL Apollo has an annual capacity of around 2.6 million tons odd, and it accounts for close to around 55% of the market share here in India. But in FY23, they should move from around 2.6 million tons all the way to around 4 million tons odd because they have a 1.5 million ton capacity that's coming up at their Raipur plant. Now, this project is likely to commence in phases in FY23. More importantly, this will be a dedicated 100% value-added product capacity. And as per the latest reported numbers, well, the total capex was around 800 crores. 60% has already been incurred.
Okay, so I'll come back to you. I have more questions, Nigel. But for now, let's get in the management and understand more about the company. We are now joined by APL Apollo Tubes Group Chief Strategy Officer, Anubhav Gupta, on the show. Hi, Anubhav. Welcome to the show. Thanks a lot for joining us. Estimates are that India's structural steel market will move to 22 million tons by 2030. So in that case, what is the vision for APL Apollo Tubes by 2030 in terms of capacity?
We are a very dominant player into structural steel tubing industry with 55% market share. On an industry size of 4 million ton, we do around 2 million tons. 2030, if industry grows to 22 million ton, we would like to have 55% pie, which we are having today. And to do that, we are ready to put up more capacities. We are ready to innovate more so that the product acceptance is even higher. For our product basket, and we have all the financials to fund that capex. Last year we had our highest ever capex in a year, which was all funded from internal cash flows. Our OCF to EBITDA, which is 70% plus. So we are all geared up to maintain this dominant lion market share of 55%, even 10 years from today.
Well, Anubhav, good to have you on the show. Y'all have the dominant part of the market, but now larger players like Tata Steel, they are being more vocal about structural steel. Is that a risk to your company?
Yeah, competition is always welcome, Nigel, in our case, because this industry is so small today, right? To make this industry from 4 million ton to 22 million ton, it has to be a collective measure from everyone. Not only Apollo can do this alone, right? So competition is welcome in our industry, and some of the steel producers have been there for many years, right? Apollo started producing steel tubes after steel producers were already making the tubes, right? So we have grown despite in presence of everyone. Okay. It's not just about having large capacities, but you have to work on the SKU range. You have to have your plants near to the raw material. You need to have your plants near to the end market, right? Your conversion costs should be low because it's a low margin industry anyways. So there are a lot of core competencies what we have built around the APL Apollo in the last 10 years, the distribution network, the influencer campaigns, what we have been running for many years, the brand pull, what we have been able to do in this industry, which is perceived as a commoditized, but we have tried to consumerize it in the last 2-3 years. And it's a mixture of much more factors, right? So we are very confident that that this dominant market share is retainable for APL Apollo, and at the same time we invite healthy competition so that everyone can work to increase the industry size. From 4 million to 22 million ton, it's not easy.
Okay, Anubhav, we'll come back to you in just a bit. Nigel, we heard, Anubhav, you spoke about capacity, but tell me about volumes now. What have they been in FY22? And also, how much of their total sales is from value-added products?
Okay, let's focus on the volumes then, Sonal. Well, as you can see, they're working at full capacity. So if demand picks up, well, they have sufficient capacity to cater to that demand. Also, their focus has been on value-added products, which means that sales volumes with EBITDA per ton of more than 4,000 rupees. And this, remember, has scaled up from around 42% a few years ago to around 63% as of the last reported numbers. That's FY22.
Okay, so let's take this question forward to the management now. Anubhav, what about sales volumes target in FY23? And by when do you think you can hit optimal capacity utilization levels on that 4 million tons of capacity? Also, is India ready for the value-added products that you're making?
What we believe is that we should be able to achieve 4 million ton sales volume by FY25. That's by March 25. We should be hitting 4 million tons of sales volume, right? So this suggests 30% CAGR versus 1.7 million ton what we closed in FY22. So we do believe that this 25 to 30% CAGR you will see every year, right? So you can put that number for FY23 as well. It has two levers. One is the existing capacity, which will be ramped up further, and second is the Raipur plant, which is all value-added portfolio that will start contributing to our numbers from Q3 FY23 onwards. So first half will be dominated from the existing capacity, and the second half we will get the contribution coming from the Raipur plant. So yes, I mean one can assume 25% growth for FY23. And then it will further accelerate to FY24, FY25, as we will have the full impact of Raipur.
Well, Anubhav, still steel prices have corrected big time. I want to understand how does it impact your EBITDA per ton? And also, when this export duty was levied, you would be sitting on some inventory. So is there some inventory loss on your books? Going ahead though from here on, what is your targeted EBITDA per ton?
As far as our EBITDA per ton range, I mean, we have been very vocal about it for many quarters now, that it should range from 4,500 per ton to 5,500 per ton. I mean, in most of the quarters, we could be in the range of 4,500, but when things are okay, and as our Raipur plant starts contributing, we will inch towards like sustainable 5,000 and 5,250 and eventually 5,500. That's a target we have set for ourselves. As far as the recent correction in steel prices is concerned, this was pretty much expected, right? Because globally the prices had started to come down 2-3 months ago. India always works on a lag. It got triggered by the imposition of export duty, but since there was a bit of anticipation of this event, so we were sitting light on the inventory, and that has been the strategy that has helped us make our business model shock-proof, right? So yes, I mean, there is no such fear of any inventory losses in our books.
Okay, Nigel, we got a sense of capacity, volumes, EBITDA per ton, but how has the business evolved? Tell me more about their financials.
Well, Sonal, since they're buying HRC steel and then converting it into structural steel, the EBITDA number, that's most crucial. And that's doubled in the last few years. But what stands out is their focus on value-added products, and also its resultant improvement in the EBITDA per ton, which is crossed around 5,000 rupees per ton from around the 3,000 rupees per ton. the return ratios as well are fairly impressive. Both the ROE and the ROC hovering around that 30% odd mark.
Okay, you know, Nigel, what actually caught my eye this time is not just the EBITDA improvement that the company saw, but profits have also seen a sharp jump in last few years, as you just pointed out. I'm guessing they have been knocking off some debt, right? And also, do you think that will continue, the debt reduction that is, because they do have some capex plans?
Well, bang on, Sonal. You know, they have been delivering a better operational performance, and interest costs as well have dipped as the company has moved from a close to around 800 crores of debt to virtually being debt-free. What has also supported them is its focus on working capital days. From around 40 days, it's come down to single digits. Additionally, the company has capex plans which focuses on value addition. Now, the total capex lined up is approximately 650 crores, and the management has said that they will be funding bulk of this via internal accruals, and that 650 crores includes the 300 crores that they've already marked to spend on their Raipur unit, which is that 1.5 million ton unit. Now, APL Apollo, they also acquired close to 4.4% stake in Shankara Buildings. That was from the secondary market in March 2022. And that purchase was done from the company's promoter entity. Additionally, they offered to subscribe to preferential issue of close to around 14 lakh warrants that will be convertible into equity shares at around 750 rupees per share. The total investment that they're going to be making in Shankara will be around 180 crores. The rationale that's been given by the management is it gives them a significant opportunity for market share expansion.
Okay, interesting points, and thank you for that analysis. But let me go across to the management with the debt bit. They have been able to reduce debt big time. So, Anubhav, since balance sheet is clean, could there be some inorganic growth on your mind? What about working capital days as well?
We are very confident of sustaining these working capital levels below 10, right? It's a factor of two things. One is debtor management. We being a dominant player, we are selling our goods on our conditions, right? And we have made it profitable for our channel partners as well, right? For them to lift our material on cash and carry. So that's why we are very confident that this is pretty much sustainable over the next many years to come, right? And on inventory side, we have today we are running the most efficient plants in structural steel tubes globally, right? So we know that with minimum inventory levels of HR coil and with like 10 to 15 days of turnaround time, and then we just dispatch the material to the distributors. So all this is learning of our like 10 years or 15 years of our operations. Right. So inventory also, we are very much confident that inventory days will remain under control. Debtor days will remain under control. So there's no reason that our working capital will deteriorate from what it is today. As far as the capex is concerned, or inorganic growth, right? So see, I mean, Apollo has been acquisitive. Last 10, 12 years, we have acquired 4 plants, right? I mean, the rationale has been very clear. Either we are able to expand geographically, or second, we are adding some new products per basket, right? So any such opportunity which comes on the table, we will definitely evaluate it very seriously. As of now, nothing on the table, but yeah, like you said, there has been stress in the industry. The weaker players are up for sale, but it has to match our rationale. So nothing on plate as well.
Okay, we got that, Anubhav, but give us some clarity on this Shankara investment. Couple of questions out there. When will you convert the remaining warrants? You know, that's the remaining 75%. When will you pay that amount? And also, is there any intent to increase your stake? Post-warrant conversion will be at around 10%. So do you intend to increase your holding even from there?
So see, I mean, there is no intention of Apollo to get into retail business. There is no intention of Apollo to run Shankara, right? The intention was just to have a small stake in our largest distributor. So our volumes could be secured in the South market. South is our largest market, and Shankara is the largest distributor in South. So he becomes a very important influencer to increase our sales over the next 2 to 3 years. So the idea is to have some stake in the company so that our volumes are secure, and we're looking for some pricing power which should come eventually, right? So there is no intention of increasing our stake beyond what we have today, and warrant conversion, we have time till September next year. It's an 18-month period for. So I guess it should happen in due course of time. There is no hurry for us to do do it like immediately. So we'll see how it goes. But we have time till September, and we have like enough cash flows in the books to do it. So we are not concerned about it at all.
That's about Shankar, Anubhav. But you had announced a merger with API Tricot, APL Tricot, that is, and that is long pending. The investors want to know, when does it become effective now?
We are also kind of chasing it, right? Because beyond a point, we can't do much. It's with the court, right? So it should have happened by Jan-Feb of 2022. But I think it's running a bit delay, with a delay of 4-5 months. So I guess we should get a final court order during this month. Once it comes, then it's like 60 to 90 days like period by when the investors will get the swap shares. So I guess within this calendar year, definitely it's going to be through. There is no delay from our side. Everything which court has asked us, we have provided with all the relevant data. But it's just that the court also has seen disruption in operation because of all the waves what we have been seeing over the last 15 months since we started the procedure. So that's the main reason for delay, nothing else. So by this calendar year, it should be.
Okay, Anubhav, thank you for that clarification. And Nigel, as we always do, let's tell our viewers about the risks and also the valuations of this stock.
Okay, so now let's start by addressing the risk first in the company. Well, they could face a probable slowdown in demand. If that talk about recession or takes place and if it percolates down to India, then that could be one potential risk. Also, larger steel players, they're getting aggressive in their space. That's the structural steel space, which they have dominated for so many years. Also, raw material fluctuation, it's a bit of a risk, depending on the inventory levels that they're sitting on. Additionally, the stock, well, it doesn't appear very cheap. PE of around 23 times, EV on a bit of around 15 times odd, but it has dominance in its core expertise and also favorable return ratios. Well, that holds them in good stead, Sonal.
Okay, Nigel, thank you so much for giving us those details. Thank you, Anubhav, for joining us and giving us all those details. That was a deep dive into APL Apollo Tubes. But time to slip into a short break now. We'll come back with another interesting stock. Sequent Scientific is in the spotlight on the other side. Stay tuned.
Welcome back. You're tuned in to Inside Out. We'll be focusing on a pharma company, but that's into animal healthcare. Well, Sonal, tell us more. Which is the company they're going to be covering?
Okay, so the company that I'm focusing on today, Nigel, is Sequent Scientific. The stock has seen a sharp decline from the 52-week high levels. It's almost down around 70%. So that's a sharp decline that we've seen. It is founded by the promoters of Strides Arcolab, and it is, as an integrated pharmaceutical company, was founded back then. Subsequently, Strides divested animal health business in 2016 to Sequent, which now manufactures formulations and APIs. In May 2020, Carlyle acquired a majority stake in Sequent after purchase of promoters' 53% stake, valuing the company at 2,100 crore rupees. Now, the company gets most of the revenues, around 70% that is, from formulations and rest from APIs or active pharmaceutical ingredients. API, as we've been talking, is the active ingredient in a drug, and formulations is the process of preparing the drug in a particular form. In terms of markets, they get around 65% from regulated markets. Now, this is a high margin market for the company and focus market for the company as well. The rest from less regulated markets with maximum revenues here coming in from Europe, which is followed by Turkey, you have Latin America, and India is just around 9%. So that's how the breakup is for the company.
Got it. All right, Sonal. So they cater to both regulated and less regulated markets as well. But we were discussing how the margins have fallen for them. Is it only the raw material issue? Since they are leaders in the space, don't they have pricing power?
Yes, they are leaders. So before I speak about margins in particular, let's just see how company has done in terms of financials. Now let's talk about revenues first. Decent growth in revenues, as you can see, from 1,100 crores to 1,400 crore rupees. But look at the margins now, a sharp decline. They were actually improving continuously, but they have now come back to square one. They halved in FY22 to 8%. Similar is the case with profits as well. They saw growth in a COVID year, but now profits have halved from the top. In terms of pricing power, now company in its own admission said that passing on the price in a largely B2B business is a delayed passing on. That's understandable. So they say they incur their cost much earlier and then they're able to get into conversations and passing on much later. In the formulations business, they are not able to pass on costs entirely. They in fact said that in API business, 60 to 70% business is with long-term contracts or in regulated markets. So when the contracts expire, they can renegotiate and gradually pass on. But it is not always the case that entire price hike is passed on. And in an inflationary environment, that of course is a negative. Company also said they're very aggressive about their market share. That is not something that they want to lose. So they are okay to take a hit on margins to some level. And this, of course, is the big risk and the reason for fall in margins as well. Also, there is too much competition in the animal healthcare industry, and that indicates they are not really a branded player, but a generic player with not much of a pricing power here.
Well, interesting. So they're unable to pass on the price hikes, even in the B2B segment. And as you said, competition is high. Then, Sonal, what happens to distribution in this case? Now, higher prices would be good for distributors. So won't they look at companies which are distributing their products at higher prices? Additionally, what does this mean for the balance sheet? And how do they plan on growing from here?
So very interesting question, Nigel. And this is something that was asked by an analyst as well recently, to which the company said that the distributors just do not go to the companies with higher prices because they need to take care of volumes and other factors as well. So this means this is a volume game now and not more about pricing and margins. The second one, company has done a lot of M&A in the past. Just look at the list. Close to 6 acquisitions in just last 4 to 5 years. 2 companies in Turkey to consolidate their presence there, a 70% stake in company in Brazil, 60% stake in a company that was located in Spain, acquisition in Germany of 100% stake in another company called Bremer. Due to all these acquisitions, Nigel, company's debt has been increasing. So from around 160 crore rupees in March 2021, it has gone all the way up to 250 crore rupees in March 2022. However, the company says that they do not expect debt to go ahead from these levels and they're comfortable with this level. And they will not increase debt despite all the acquisitions that we have seen in the past.
Oh, interesting. Very, very interesting piece this is, Sonal. But before we wind down, tell us about the risk as well as triggers for the company from here on.
Okay, so let me talk about the risk. Of course, the fact that we have been discussing that they're not able to pass on entire costs, and in an inflationary environment, this will definitely hit margins for them. Debt has been rising, as we saw, due to acquisitions, and due to the same acquisitions, there are a lot of write-offs as well in their books. For triggers, now let's talk about what Sequent is planning in terms of launch. They are planning companion animals business to be launched in Turkey and Brazil, and it has been a successful rollout in India and emerging markets. Animal health experts suggest pets business is the fastest growing segment in the domestic market at 25% compared to overall 10% growth for the market. The expansion in Vizag in Germany will allow the company to deliver healthy mid-teens growth over the next few years. Debottlenecking at their Mahad plant, that is also positive. Let me talk about shareholding as well. We are talking about sharp fall in the stock, Carlyle holding some stake. So there are some interesting names here. Ashoka India Opportunities Fund, there is ICICI Lombard holding 1.07% stake. Unit Trust of India holds 3.5% stake. And after all the fall that the company has seen, the valuations for the company are quite reasonable. It's around 11 times a one-year forward earnings. So, of course, it's quite reasonable. But there are definitely some risks associated with the company.
Well, interesting, Sonal, because there are risks, there are challenges as well. The stock has seen a sharp correction, but valuation-wise, it's fairly attractive at around that 11 times odd. Well, that was an interesting piece on Sequent Scientific, but we have completely run out of time on this edition of Inside Out. It's goodbye from Sonal and myself.
But do write to us and tell us the companies you want us to discuss, and we'll feature them on this show itself. Thanks a lot for joining us.